This episode of the Earmark Podcast is brought to you by Botkeeper. Botkeeper works with QuickBooks and Xero, the most popular online GLs. Free yourself from tweaking rules and accessing your clients' financial accounts. Botkeeper automates it all and learns as it goes.
A lot of folks will tell me, Dan, you're underpricing that though. And I said, well, yeah, if I was doing all the work myself, I would be underpricing that. But I'm not doing all the work myself.
Right, because you're leveraged 1 to 20.
I'm leveraged, right? So as I'm levering my time, I'm able to provide more with less.
If you'd like to earn CPE credit for listening to this episode, visit earmarkcpe.com. Download the app, take a short quiz, and get your CPE certificate. Continuing education has never been so easy. And now, on to the episode. Dan, welcome back. It's great to see you for part 3 of this discussion on the Path to Advisory.
Cool. Thanks, Blake.
How you doing?
I'm good. Another week, man.
Well, the last 2 times we talked, we discussed how to scale an accounting firm in advisory through the lens of FP&A. Productization of that service, what exactly is in it, what is the product that we are delivering as part of a productized finance function. And you use the term finance as a service, which I love. And if you're just tuning in, go back and check out those previous episodes in order to learn about what that is. So we talked about productizing advisory work, the framework around it, including the annual strategic business cycle, the annual operating plan, the budgeting, the forecasting. And one thing that we have not yet discussed, which is super, super important, is the staffing. How do you actually deliver this? Because if we are scaling this, we as partners, as directors, as managers cannot be doing this all ourselves. And that is the secret recipe, or the secret sauce for you anyway, if I understood correctly last time, right?
Totally. Leveraging people. That's the secret sauce to making money in this business.
We mentioned that you use financial analysts, or that's the term you use. The role is a financial analyst role when it comes to delivering finance as a service. So explain to me the difference between an accountant you would hire in GrowthLab and a financial analyst that you would recruit. They operate on separate teams. They have different roles. Help me understand the difference.
Correct. So when hiring for a senior bookkeeper, a staff accountant, even a controller, I'm looking for someone probably no different than the rest of the industry, someone who has had either 5-10 years of actual experience in doing the bookkeeping, the reconciliations. More importantly, I would say it's also navigating the systems and how to actually integrate them and sync them. For a controller, I'm really looking for someone with more of that traditional debits and credits, understands GAAP, maybe some light FASB, work papers, the importance of having supporting work papers for each account on the balance sheet. And then other things such as revenue recognition, accrual accounting, etc. That's a very different skill set than needing someone who, never mind the business acumen or the financial acumen, but somebody who understands cash flow modeling, obviously has some experience, either academic, mostly academic, around a balance sheet, financial statements. Maybe it's a little less about aptitude, because surely you can take somebody that has an accounting degree or a finance degree, and you can probably train them in sort of the world of financial analysis, FP&A. But it has to do maybe more with attitude. Somebody who can deal with ambiguity, has organizational agility, because remember, FP&A is the connective tissue between business strategy and accounting and financial information. Somebody who can see beyond sort of the current state, and then can articulate a journey from the current state to future state. But at its core, what's still important, regardless of the role, it's cadence and rigor, right? Cadence, being able to understand workflow, meeting workflow deadlines, and then lastly, around the rigor, what is being delivered, how is it being delivered, regardless if it's 2 or 3 financial statements or actuals to budget and annual operating plan.
I like what you said there about the what was it? It was curiosity or the difference.
Definitely intellectual curiosity. What's, someone who wants to scratch that itch works really
Right.
well.
And so you're typically not recruiting accounting graduates into these financial analyst roles. What kind of degrees do you look for? What kind of experience do you look for?
So, ironically, we do have one individual who has an accounting degree. Everyone else is everything from econometrics to finance to more general business, depending on the college. Some liberal arts schools obviously don't have a structured business program. And yeah, ironically, the only individual who actually has an accounting background is Corey Cornoyer, who never, I wouldn't even put him in front of QuickBooks. He spent his entire life in front of spreadsheets and, of course, more recently in front of Giraffe. He does extremely well with the details. So he understands the debits and credit and the theory, but what he really enjoys is more of that blue sky, carte blanche sort of opportunity to build a plan, tell the story around that plan. So I think it goes back to attitude more
Mm.
so than aptitude, but definitely two different tracks, two different career roadmaps.
And where are you going out to recruit? You guys are a firm of, is it a few dozen now, 30, 40
Yeah, we're about
team members?
28 as
Yeah.
of
So
Q4.
so you're in an interesting spot because you're not small anymore, right? More than 10 I would consider is no longer small. So you're in the mid-sized firms, but you're also not large. So it's hard to compete, I imagine, with some of the larger firms recruiting out of school. Did you say you're not recruiting out of school? You look for folks with experience already?
On the contrary,
Oh.
uh, 100%. So for FP&A, it
Mhm.
is 100% right out of school,
Oh, okay. Gotcha.
maybe 1 to 2 years of experience. But we're actually in the process because our goal is to achieve a 1 to 20 leverage. That requires to build the bench, the entry level bench, right? And as we grow and scale, the hope is, of course, and it's happening because we're seeing it. 1 or 2 folks are starting to pop into that level, building up the bench so that you can bring this young talent to the next levels such as senior financial analyst, director of finance. I mean, they have years, 15, 20 years to be a CFO, but that's kind of how we're looking at it.
So you said 1 to 20 leverage. Do you mean 1 staff per 20 clients?
So it would be 1 hour of my time to 20 hours of a financial analyst time.
Got it. And then that ratio is obviously lower for the other folks on the team. So,
Exactly. But it's a
okay.
1 to 1, I guess, if you're at the bottom of the.
So let's talk about then the hierarchy, if you will, of this. So I come into Growth Lab. I am a business major, and maybe I've got like some experience doing a little bit of spreadsheeting. I've got enough accounting knowledge to be dangerous, but not enough to be boring, right? I have curiosity, and I have that attitude that you said. So who am I going to be reporting to? What kind of stuff am I going to be working on? What's a day in the life of your junior financial analyst?
Great. So if you just recently joined us, you recently graduated from college, you're probably in the junior FP&A analyst title role. You will be reporting not on an HR basis, but within the function. You'll be reporting into a senior FP&A analyst and or a director of finance. That director of finance and and senior FP&A analyst will be reporting into one of the CFOs. In this case, it's either myself, Stephen, or one of our other team members. And so today we're only 3 layers deep. And if you add interns, we kind of treat interns and junior FP&A analysts at the same level. In terms of recruiting, you had asked earlier how we approach this. Yes, we do quite a bit of college recruiting. I actually step into classes at universities, especially here at Brown University in Rhode Island, where I do teach young talent students about financial and business modeling and how and what the importance of business modeling is to telling your story as an entrepreneur and grounding that story in financials. Why I went into that. So part of our college recruiting program is the way we describe it is, so you can go into public and you can spend 2-3 years there. And the beauty of going into public is you get to see a lot. Like the breadth of what you see is amazing.
So
The
you're
depth.
you're talking about the conversation that you have with students when you are recruiting them. You
This
get
would be the conversation.
okay. So that's one option is going to public, get that breadth.
Get that breadth. But you don't usually get the intimacy, right? You don't go deep into that business model. On the contrary, or on the flip side, if I may, you can go into corporate America and you can get yourself a corporate accounting job or a corporate financial analyst job. And then chances are you're going to be in that role for 1 to 2 years until you sort of move up the ladder. But the nice thing about going into corporate is that you get to go really deep with that business model. You get to create intimacy with that environment, but you don't get to see a whole lot, right? And so those are the two sides of the range. The way we tend to describe the experience, your career roadmap here at GrowthLab, regardless if it's accounting or FP&A, is that you get the best of both worlds. So you're not getting yourself 100 customers and different business models. You're probably going to have actively 10 to 20 different customers, but you get to go really deep with them because of that cadence, right? We're always in contact and we're deep into the business model and also into different functions within the business, regardless if it's HR, capital raising, product development, et cetera. And that really gets the juices flowing for someone who's not in accounting. And once they want to be in finance, but they're not ready to, they don't want to go to that banking environment, highly structured, you're sort of like in a cubicle. I just recently hired someone who it was between GrowthLab and going to a top 20 bank here in the US. They ultimately came to us because of the exposure to different business models and the exposure to different functions, right? The building their business acumen when they're really young.
Yeah, it's a good way to position it. Like in between having so many clients that you're overwhelmed and you never really get to know them. That's public, and then often can be anyway, and then or big public firms, and then you've got going into industry where it's just one company. So you're giving them the option to or the opportunity to get to know a bunch of different kinds of businesses
To go wide and deep.
Yeah, that's great. Okay, so I'm sold, Dan. I want to work at GrowthLab, but I don't really have any experience. I'm coming straight out of school. Maybe I've done an internship or something. Like, how do you train these folks to be able to do financial modeling? I mean, because that's the core of the product that you are offering.
Right. So I took a page out of my own experience when I was in my 20s, and I'm very grateful for the exposure I had in my 20s. I was fortunate enough to have a career in a management team at multiple companies that allowed me to be that fly on the wall, allowed me to observe and listen, help me build my business acumen. And I had plenty of time to become the spreadsheet jockey modeling expert. And we kind of leveraged some of that in the beginning. So if you had talked to me back in 2014, 2015, 2016, that's how we were grooming team members. It doesn't
Letting
work.
them sit in on meetings, learning by observing you at work.
Right.
Yeah.
Letting them sit in the meetings, how we approach things, different scenarios, dealing with, hundreds of different business models, never mind personalities. That was great 5 years ago. And I don't think I would have done anything different, but I got to tell you, that doesn't scale fast enough. But
Yeah.
because it's very difficult to hire for this type of role, because this type of role, it's either all or nothing. To fill this type of role, you're looking for somebody who has 10 to 15 years of true finance FP&A experience, but yet this type of role doesn't really exist. It exists in corporate America, but you're only dealing with one business model, one customer, one management team. But to find this role, this function, these capabilities in, say, a public accounting, it's very difficult to find that. And so we We struggled with that in the beginning, to be honest. And so that's why we defaulted to sort of the longer, more prolonged onboarding process, training and development process, which worked really well for our first two analysts. Today, that's not the case. Today, now that we have more of a team, we just recently hired two more analysts back in August, September, and they're not partaking in meetings, right? They're not the fly on the wall. As a matter of fact, they're part of a small team, and their number one job is to crank out models under the supervision of a director of finance. And so this director of finance sort of splits his time about 25% focus on this team that their sole job is they're literally in a room cranking out models. The good news is it gets isolated. Nothing leaves that room without a second, third set of eyes. Now, why is that lever? Why can we actually scale that? Because that's like a 3 to 4 month process. I just had a conversation with one of them, and it's amazing what they have learned in 2 to 3 months, less than that.
Mm-hmm. Well, they're getting to build models under the supervision of folks who really know what they're doing, that director of finance, and it's all getting reviewed and they're getting feedback. And I could see how if that's all you're doing for a few months, you could get really, really good at it.
You get really, really
Yeah.
good at it. And it is analogous to how back in 2014, 2015, how we were onboarding young talent to join the accounting and bookkeeping side of the business.
Learning by doing.
Learning by doing a very discrete set of inputs and deliverables. I used to call it a very short leash, 30-minute, 60-minute leash. And there's always a very high velocity feedback loop.
When you say leash, you mean they're going off and working on something, coming back an hour later, and then getting some feedback. Got it. Yeah. That's a lot better than just letting people go for a few days and hoping that they learn something.
And that works great in large
Yeah.
companies.
Right.
But not here.
Yeah. Well, you don't have the time to waste,
I don't
right?
have the time.
What if they spend 3 days doing nothing useful? Right.
And then you're going to spend a day unraveling it all. Yeah.
Right. Okay. So that's the experience, junior financial analyst. They come in, they learn by doing. They're in the room, they're building the financial models. And going back to our previous discussions, those business models are really the core of how you build forecasts and budgets that become part of this productized service offering. So it's really important that they learn how to do that from scratch.
Right. And they have no exposure to pay for performance, employee comp, annual strategic business planning. They're sort of just doing it, right? And as time goes on, you begin to open up their exposure to the bigger why. Why am I doing this? Why am I cranking out a 5-year plan? How is that 5-year plan part of something bigger? Now you begin to bring them in slowly into that cadence and that rigor, the team to deliver that service to the customer.
So that means, I take it then, after 3 to 4 months, they are now starting to be in those client meetings.
Exactly.
Okay. And who leads the meetings? Is it the senior financial analyst for most of them? I think I remember that's what you said last time.
So it's really a function of the package that the customer has decided to pursue. If it is one of our two first packages, lower level packages, then it would be a senior FP&A analyst and or a director of finance.
Gotcha.
But then again, if they need higher level conversation, dialogue around capital raising, cap tables, or pricings, contracts, then we as CFOs can spend that 5 or 10 minutes with our team and or the customer, adding additional value at no cost.
Hark! I am the ghost of Christmas future. I have come to...
Wait, what? Christmas was over months ago, and I'm pretty sure no one says hark anymore.
Sorry. Since the Great Resignation, there aren't many of us future ghosts left working, so, well, I'm stretched a bit. I should be working on my holiday hauntings, but I'm picking up the slack.
Yeah, it's tough out there for sure. My accounting firm has real capacity problems too. If we could find a way to tackle the work we have and still grow the firm, we'd be in great shape. But we're bogged down with all these menial bookkeeping tasks.
That is why I have come, to show you the future of bookkeeping.
That's great, but I'm standing right here.
Oh, sorry.
You got my attention, though. Let's hear about the future of bookkeeping. At this point, I'll even take unsolicited ghost advice.
The future of bookkeeping is Botkeeper. It will free your accountants from the chains of data entry, reconciliation, and verification. And now, if you schedule a meeting on or before March 31st, 2022, you could win a year of Botkeeper bookkeeping automation free. Just visit botkeeper.com/win for details and rules.
Wow, a free year of Botkeeper? That sounds pretty amazing. But we already have an online GL.
Silly mortal. Botkeeper works with QuickBooks and Xero, the most popular online GLs. Free yourself from tweaking rules and accessing your client's financial accounts. Botkeeper automates it all and learns as it goes.
It sounds fantastic, but we're so busy, we don't have time to implement new systems.
Botkeeper is quick and simple to implement. And they even help, like Santa's helpers.
Okay, I'm interested. How do I get started?
Just visit botkeeper.com/win. And merry!
Yeah, still not Christmas.
So how long do you anticipate it will take a junior financial analyst to mature into a senior financial analyst? Is it similar to a year or two that you might do in public accounting to go from staff 1 to staff 2? Is it longer, shorter?
So I think, again, we're still fortunate, Blake, that we're small enough and there's enough intimacy around the team and feedback loops that I can pretty much take a junior financial analyst and make that individual into a senior financial analyst with the ability to run at least low-level meetings.
And how soon can you do that? Do you
12
think?
months.
12 months. Okay.
Easy.
Gotcha.
I would tell you within 6 to 8 months, we've already started allowing them to sort of interact with the customer directly, assuming they have the right attitude, right?
Well, that's important, right? Because they got to learn how to talk to clients at some point.
They do.
So sooner rather than later is probably for the best.
Yeah, and I'm a big believer in stretching. So,
okay, so let's say I've made it to senior financial analyst. We already said the big part of that is owning a customer relationship, especially those folks who are on the lower tiered finance as a service plans that you have. What else am I doing as a senior financial analyst as part of my day to day?
yep, good question. So, first and foremost, you're there for the customer.
Oh, and I should ask this too. I'm curious. You've got the accounting team that does the books, and you've got the finance team that does the planning. How does the customer interact on like what's the balance of that on a day to day or week to week basis? Like, does the customer know for accounting stuff I go to this person, for finance stuff I go to my senior financial analyst? Like, how do you?
Yeah.
I guess. Yeah. How do you handle who gets what?
Yeah, and that's actually the basis of one of the reasons why, we have taken a deeper look into our workflow altogether. But I would say if you are a full service customer, but on the first or second tier, without active CFO services, it probably feels a little more like 30-40% accounting and 60-70% FP&A. Why? Because the FP&A team has at a minimum 2 meetings per month with the customer. In the first 3 months, as we discussed earlier, you got this intricate onboarding process where your customer is connecting with the FP&A team at least once a week to build that model. Whereas on the accounting side, after 1 or 2 initial accounting cycles, bookkeeping closes, then that customer goes from the onboarding accounting team to the what I call the recurring accounting services team. And normally it is, obviously one financial close done by the controller or a senior accounting manager. And then behind the scenes, it's either a junior accountant or a bookkeeper that rarely has a lot of contact with the customer. So on an intimate sort of one-to-one, it'd be like 1 meeting a month on the accounting and 2 to 4 on the FP&A side.
Got it. Okay. That makes
So
sense.
FP&A is really like the dog wagging the tail here.
Okay. So getting back to where we were going with this, senior financial analyst, I'm having meetings with the client. I'm updating their financial model. I'm training junior financial analysts. Maybe they're working on my clients with me.
Mm-hmm.
Anything else that springs to mind?
So you're ensuring that the workflow is accurate, right? You've got the right cadence. You're coordinating with the accounting team if there are any changes. So because you don't have one individual managing the customer relationship, and as you know, like in business, a lot of stuff comes up, especially if you're a scaling startup going through capital raising, product development, customer acquisition, like there's a whole lot of stuff happening. And there are things that happen on the finance calls that aren't really happening on the accounting calls, things that are happening on the ops and sales calls that accounting has no visibility into. So one of the things like that a senior financial analyst has to do really, really well is making sure that information flow is happening across all teams, not to mention tax and CFO services. Because there are times, I mean, everyone's having multiple conversations with the customer,
Got it. So
and
this
that's the
person
biggest trick in this service level.
is yeah, keeping it all handled and stuff not getting dropped. So this financial analyst person is also kind of responsible for just keeping it all together, making
Keeping it
sure
all
everyone's
together.
okay. Got it. Well, there's plenty to do there. That's for sure.
Yeah,
Uh,
it builds a lot of the softer skills, right?
yeah.
So you're not coming into this with this is how you do revenue recognition, this is how you close the books. You got to be able to come into this and say, okay, here's a cash flow model or a 5-year plan that we already know off the bat is going to be wrong, but at least it's like, the 80-20 rule. And then two, you got to make sure that the flow of information like hits all parts of our team and that it's captured somewhere.
So how much am I gonna building an FP&A practice? How much am I gonna expect to pay for these folks, these roles?
Good question.
Yeah, what should I offer? What to be competitive, right? I need to offer good compensation, benefits to these financial analysts. What can you share with me that would help me do that?
So I would say a junior financial analyst that has very limited experience,
Yeah, let's say straight out of school.
straight out of school, you're looking between 35 and 50.
Okay.
And my
And
voice
then
just went down. You're looking at
well,
35 to 50.
yeah, well, and that actually is, not that far off from like entry-level public accounting positions, right?
It's not.
It's kind of similar. And they're accepting that because they're going to learn a lot at the same time, right? With the
Right.
expectation of being able to grow in the firm. So once you've, gotten past your, 12-month period of learning, like I assume you bump them up once they become seniors.
Yeah, I mean, so Blake, one of the risks inherently in our industry is you train people and they leave.
All the time, right?
So yeah, it's got to be a balance.
Right.
So if you know you're going to be spending hours on end training and developing so that they can be at the top of their game in 12 to 24 months, that earnings curve is quite steep. So if you ever seen a hockey stick curve,
Yeah,
it's my
yeah.
financial analysts.
So the better they do, the more they can make.
Right. And then we actually put them on a corporate bonus program. So our typical senior financial planning analysis analyst will be on a 10% corporate program.
So 10% of their compensation is performance based.
10% of their salary would be performance based.
Got it. So I'm guaranteed 90%, and then the other 10% I can earn by hitting certain objectives, targets.
And our targets are all at 100% revenue. That's all we care about on that side of the business. 100% revenue. And if you hit stretch targets, you get two times kicker, 2 times multiplier of your bonus.
Okay, so I can earn 20%.
Yeah.
Then, okay, got it. And it's all revenue based. Do you allocate revenue from the clients then down to the analysts that's responsible for that relationship? How do you do it?
No, I don't. For me, it would be we care about the entire system and less about whether one customer or one individual is quote unquote profitable.
Okay. So I'm trying to understand how you do these calculations because so like I'm a financial analyst. I've got what, a dozen clients, maybe 20.
Mm-hmm.
So we know the revenue as a firm for each of those clients. So you just sum up that and then that's like my target. I have a target, and if I exceed that, then I'm good.
So
Or
we only have division level targets. So we don't have team level. We don't have individual level. It is division level. So the entire financial plan analysis team has their revenue
I see.
target
I see.
because we want to make sure that, one, we're acting as a team. If I've got this project team off to the side that are building the models, regardless of like what customers assigned to them, and then I've got the senior analysts that are managing the relationships, we're all in it together.
Yeah, that's interesting because that's very different than a hourly billing type of performance compensation model, right? Which is what we're used to often in public accounting. And so you incentivize the team. You say, here as a team, finance team, if you hit this revenue threshold, then you're going to get your bonus, and if you exceed this, then here's the kicker.
Right.
And so everyone works together to increase the revenue.
So the way we manage gross margin and capacity needs, capacity utilization based on customer flow is we take a page from like Lean, Six Sigma, tack time. And so every customer, we plan that one customer is going to require at least 2 hours a week of a senior FP&A analyst and 4 hours a week of a junior FP&A analyst, especially in the beginning, right, as we're onboarding. As time goes on, now you can take that allocation per week, multiply it times 2. So you're looking at 8 hour. And we do this in chunks and blocks. So you have 2 4-hour blocks each day for the junior. You've got 4 2-hour blocks for the senior. So now you can begin to build your model based on that information.
Yeah. And so basically, like, a senior is at most going to be able to handle like 4 clients a day if they were able to do it all at once.
Right.
So
20 a month.
Yeah, 20 would be the max, right?
Max.
Gotcha. And that's if they're hustling, I imagine. Okay.
And you got to there's development, there's other learnings, Wall Street Journal, go read a book.
That's on their own time, right?
No, I tell them, if you're not modeling, make sure you're picking up the Wall Street Journal.
That's great. And then you said this earlier, the CFO, finance director folks, it's a 1 to 20 leverage ratio. So the idea is, it comes down into minutes per client per day, I suppose, for those folks. But we could do the math and figure it out. I'm not good at doing math on the fly, so I'm not going to try. I need my spreadsheet open. Okay, so that all makes sense. That's great. That's really helpful. And with that team, you are able to, manage a book of business for this finance as a service productized offering, and you know what your costs are, right? Because you got fixed salaries for the staff, and
right.
Are you interested in being more of an advisor to your clients? There's an app that can help you get there. Its name is Liveflow. Have you ever exported a QuickBooks Online report to a Google Sheet, spent time customizing the sheet, invited others to collaborate, then discovered the QuickBooks data had changed, forcing you to start the entire process over again? Liveflow has solved your problem. Liveflow connects QuickBooks Online directly to Google Sheets, allowing you to have sheets that automatically update with the most recent QuickBooks data. Accountants are using Liveflow today to create automatically updating budgets versus actual reports and consolidated reports. Yes, you heard right, consolidated reports. You can connect one Google Sheet to multiple QuickBooks Online companies and focus on providing better advice. Liveflow has a special offer just for the listeners of this podcast. Get 20% off your first 3 months. To claim this special offer and learn more about using Liveflow, go to liveflow.io/earmark. That's liveflow.io/earmark. Well, now we got to talk about the revenue portion, right? How do we price this stuff? This is probably what everybody has been waiting to hear for the last 3 sessions that we have done this. So what can you tell me about the different tiers that you've mentioned? You've got some starter tiers and you're doing fixed fee pricing. What is your secret recipe here for coming up with the price?
Yeah, so the secret
Let's start at the bottom. We'll start at the
bottom.
basic. Yeah.
So let's start at the bottom with full disclosure. Pricing is an art, not a science.
Yes, indeed.
2, you got to know your customer, the persona. Our goal here, at least at our company, is to bring on companies that are in that seed Series A, that are beginning to appreciate the value of planning, but not just planning for just one-time event, but the rigors of planning. And it needs to be at a price point that makes sense to them initially, because the FP&A package is truly a hook for bigger and better things later on. So we have priced out our FP&A package 1 and package 2. I think the marketing team calls it something else. But for simplicity, you got the first and the second tier. And I believe the first is priced at $1,500 and the second is priced at $2,000. Now, what do I get for that? Well, again, you kind of, you
Sorry, you said 1,500. Tier 1 is 1,500.
$1,500 for tier 1 and $2,000 for tier 2.
So that's not a huge difference in the two tiers. So
It's not, but that extra $500 allows for that additional meeting and the prep work that goes into that additional meeting. So it gives us a little bit of a buffer.
Oh, so and that's where you add in the finance director, CFO level input.
Not so much
okay.
the CFO level, but it allows us to more elevated folks and additional cadence and actually more output, right? Instead of just like investor reporting, now you're talking about budgets, actuals, maybe presentation to the investors, board meetings, et cetera. So you could, without the need to have someone like myself taking the lead on that project, now it's a more of a collaborative effort between the business owner and the business and that team and their team's like finance team.
Okay, so let's go to tier 1. I'm getting a junior financial analyst, obviously, and I take it I'm getting the senior.
Correct.
Okay, so we got a junior and a senior. No higher level folks at that point. Am I right?
No, but again, we're not the type where if you call, I'm going to charge you every 6 minutes for the call. But I usually tell folks, 1, I enjoy speaking to the customers, and 2, it's just a great opportunity to do a check-in. But no, it does not officially include CFO services.
You're not getting the regular check-in with the CFO, the regular. Got it. It's just as needed. Okay, $1,500 a month. Let's talk about what else is in that package. Like, what is the product?
So definitely a 3-year long-range plan with not like an entire suite of drivers. It's going to be a tighter plan, simplified, and then coming out of that, you're probably not even going to have a liquidity, the capital raising tranches in there, but it's a 3-year plan. Then you get your annual operating plan, and then you get your annual operating plan updated, and you get your rolling forecast every month.
That seems simple enough. So simplified 3-year long range plan, but you're not doing the fundraising component of that where, that would mean like, okay, what if we went out and raised a bunch of money? We got a loan, all this financing stuff. That's complicated.
Scenario planning. Yeah.
Right. No. This is more just like business as is. How will it go over the next 3 years?
Yeah.
And then simplified drivers. So you're not doing crazy revenue forecasting with all sorts of different products and services and whatnot.
Yeah. Plain vanilla planning.
Got it. And then you get the annual operating plan, which is the budget. That includes then updating that. How often do you update it? Quarterly, annually?
I'm a big fan of updating it once a year in June as of, for July 1st. And it really allows you to take inventory of the first 6 months. And if you're bonusing out or paying for performance, people are banking on your annual operating plan, your budget, for you to hit your budget. So it's up to you as a management team to figure out what you're going to do to hit that budget in the last 6 months of the year if you're not on target.
And then the last thing is the rolling forecast. And that is basically the financial reporting package, the management reports with do you forecast out 12 months at a time each time you issue?
Yeah.
Or 6 months?
Yes and no. It's usually through year end.
Through year end. Okay, got it.
But you always capture the outer months, right?
Right. And you're using FP&A software, you're using Giraffe, so it's easy to do that rolling forecast as part of the regular management reports because it's just feeding in the annual operating plan,
right?
And the forecast. Okay.
Yep.
All right, that's great. Very helpful. So now at the tier 2, $2,000 a month, you're adding in CFO.
So, yeah, you're
not CFO.
You're not adding CFO, but you're adding in a more robust staffing roadmap. You're adding in some pay for performance comp and dashboards, conversion rates off of your RevOps team or your inbound marketing. you're going deeper into that second derivative of the drivers, not just taking it at face value. You're also
That's really interesting. What you said, second derivative drivers, and I know a lot of folks who took calculus who hated it, or probably, their brains turn off when they hear derivative, or if you took if you had to study that for the CPA exam, accounting for derivatives.
good.
I never learned that. Good.
Never learned that.
Luckily, it didn't show up on the exam, so I was good. When you say second derivative drivers, like, give me an example of what would be a simple driver, and then what would be a second derivative type of driver situation.
So the easiest one would be, I expect my revenue to increase by 25%. Okay, great. So that's a CAGR, easy.
Yep.
But then why? The why begins to unravel, peel back the onion, right? And the why could be, well, I expect to acquire X amount of customers. Okay, great. How are you acquiring those customers? What's the customer acquisition cost? Okay, so now you're taking it deeper and deeper into, 3-4 layers of that original driver, which was, I expect my revenue to increase by 25%.
Okay, so tier 1, tier 2. Is there a tier 3?
There is. And so tier 3 is where we get into more of the CFO role. So our tier 3, I believe, starts at 4,000, and that includes the second package of the FP&A, layering on a more active CFO role, where the CFO is actually meeting with the customer on a weekly basis for a half hour, 45 minutes, or there's definitely going to be meetings once a week. Reporting requirements are going to be more robust, and usually there's a board meeting, there's investor report out. Now the good news is, because a lot of folks will tell me, Dan, you're underpricing that though. And I said, well, yeah, if I was doing all the work myself, I would be underpricing that. But I'm not doing all the work myself.
Right, because you're leveraged 1 to 20.
I'm leveraged, right? So as I'm levering my time, I'm able to provide more with less. And so, I always say, when you hire some of the fractional CFOs, especially like 5-10 years ago, and you pay them $1,500 per diem, or you're paying, $300, $400 an hour for fractional CFOs, 80% of the time you find those individuals not really working on business strategy, but working on things that financial analysts should be doing, controllers should be doing journal entries, putting together spreadsheets. That's not what you need a CFO for. And so what we have decided and what we have done is we've taken essentially what you would get from a part-time CFO that you have access to 4 times a month, per diem pricing, which could be upwards of $6,000, $8,000 per month. We've taken that and what you get from that, and we've been able to give you the same, but at a lower cost point.
I should ask something very important, which is, does this include the accounting, or is this just for the FP&A?
This is just the FP&A. And the reason why it's just the FP&A is I can really templatize if I've got my annual strategic business cycle as my framework, right? That's my guiding light, that's my beacon. And then I've got what I'm going to do, the underlying tasks or work or projects that you're going to do either throughout the year or in each month. I can pretty much put a bookmark on that. On the accounting, good luck, because growing businesses every month, they're adding a new chart of account, they're opening up a new bank account, new credit card, they got a new employee, and revenue is growing, expenses are growing. So it's very difficult to just put one flat fee, as you know, obviously.
So for the accounting, are you doing fixed fees? Are you doing hourly or combination?
100% fixed fees.
Okay. On everything,
And I love it because it forces us as a service provider to spend a little bit of extra time scoping the customer out. And maybe I don't need to leave money on the table.
Is there a tier 4?
No. So the tier 4 there are variations. So I said like our starting price would be 4,000. That can go, we have customers that are, we've had customers that are 20,000 a month, although we don't like them. We love them. We love those customers, but we're not in pursuit of those customers. Those tend to be the anomaly now. Maybe 5 years ago,
it's not scalable,
right? So our sweet spot is really that 2,000 to 3,000 up to 5,000 a month type of customer. That's what we love here.
Well, and it makes so much sense from a customer standpoint too, because what are the alternatives that they have? They could go and get a fractional CFO and pay $300 to $500 an hour, or they could hire a CFO who's going to end up spending most of their time doing non-CFO work. So it's not a good use of funds. It's very expensive to hire somebody who's going to spend most of their time doing, controller or senior accountant level work.
Mm-hmm.
And so really you're providing them what is a better experience, because I would rather pay a fixed fee than pay $300 or $500 an hour, right?
Yeah.
Like,
And we've covered like over this series, we've talked about in one way or another, the cadence, the rigor, and then the team. Like today we spent a lot more time on talking about the team and hiring and how you organize that. But the reason why we can do what we do with our team and have 22-year-olds right out of college, like working on your model, is because you have all the other stuff that we talked about previously. You've got systems like Giraffe, you've got the cadence, you've got workflow systems. So I'm not spending hours looking for a broken link or version
right.
control.
Version control on spreadsheets or emailing the spreadsheets around. To me, it's sort of similar from the bookkeeping world, right? I started out in bookkeeping, emailing QuickBooks desktop files back and forth, right? And we would run into version control issues. Maybe they'd send me an accountant's copy and then make a change. And
or
then
Mac to PC.
Yeah, and we couldn't merge it back, and then we'd lose days of work. And we've eliminated that with the right technology, and we haven't talked a lot about the tech. Maybe that would be a good future episode, but what we wanted to talk about here was the productization of the offering, and I think we've got a pretty good idea now of what that is, right? So let's just summarize it again, just to be super clear about what it is that we are offering here. We are giving people a long-range plan. We are giving them a 12-month annual budget. We are combining that with our management reports, our financial reports, to produce a rolling forecast that shows them where they're going to be at the end of every year, right?
And you're
at the end
doing
of the
it
year,
every month,
every
certain
month,
times of the year,
and meeting with them twice a month to go over this stuff, whatever they need, right? One meeting is let's go over your financial reports. The other meeting is we'll handle all the other stuff that comes up. And there's plenty to talk about throughout the year. And you've got this, ongoing relationship with folks, with businesses that really need this kind of service, that need this help and can't afford to hire a CFO. So
it limits scope creep.
So what limits the scope creep?
So I hear from other companies that their biggest challenge is being able to charge to get paid for services, especially ad hoc services that they're providing. If there's one thing that pandemic has shown accounting firms is you got to get paid for the services and value you provide.
Yeah, well, and a lot of firms during the pandemic, they didn't actually get paid for their PPP consulting. Amazingly.
Exactly.
A huge chunk just didn't know how to charge for it. But you were basically already charging for it, or did you do extra? I'm curious about that.
Because it depended on the customer, actually.
Yeah.
If you were a full service FP&A with CFO customers, we actually did not charge for ERTCs, PPPs. We didn't have to because it was just part of what we were doing. Like we had access to it.
Mm-hmm.
And so we didn't charge for customers that were in the higher level packages. We did charge for those customers that were bookkeeping or just accounting or just tax. We did charge extra. We did not do success fees though. It was all flat fee. It was anywhere between $1,000 and $2,500 for a normal ERTC. And there was a lot of work that went into the ERTCs and PPP. And more importantly, never mind the work, it was a strategy in optimizing PPP versus ERTC.
Yes.
And a lot of people, they moved too quick. And we told all of our customers, do not file for forgiveness until the dust has settled on your payroll for that quarter so that we know what's the exchange of ERTC versus PPP expenses.
Yeah, and I'm sure they appreciated that foresight when it turned out that you really needed to pick one or the other, at least at the beginning.
They appreciated it. No. They're still waiting for the money, though.
Well, fortunately, our listeners don't have to wait for your insights, Dan, because you have already shared them with us in these past 3 sessions. So thank you so much.
Yeah, no, I appreciate it. Thanks,
Yeah.
Blake. This was great.
Yeah. Hey, by the way, if our
Sure.
listeners would like to learn more about GrowthLab and get in touch with you online, where is the best place for them to do that?
Yeah, totally. So you can always go to our website at growthlabfinancial.com, or you can shoot me an email at dan@growthlabfinancial.com, and of course on LinkedIn.
Thanks, Dan.
Thanks, Blake. Appreciate it, man.
Thanks for listening. I hope you enjoyed this episode and that you learned something new. And if you did, wouldn't it be nice to get some CPE credit for it? Well, I've got great news. My new app, Earmark CPE, offers free NASBA-approved CPE credits for listening to podcasts, including this one. Visit earmarkcpe.com to download the app, take a short quiz, and get your CPE certificate. That's earmarkcpe.com.